Welcome to StokTok's deep dive into Commonwealth Bank of Australia. The company is Australia's largest bank by market capitalization, a systemically important financial institution that generates revenue through consumer lending, deposit taking, wealth management, and institutional banking services across Australia and the Asia-Pacific region. It matters because Australian households and businesses depend heavily on the bank's credit intermediation, and its health is a barometer for Australia's financial system. Over the trailing 52 weeks, the stock has traded between $96.94 and $136.85. As of May 8, the stock is trading at $128. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Commonwealth Bank operates across three major segments: consumer banking, which includes mortgages and deposits from retail customers; institutional and commercial banking, which serves corporate clients and provides trade finance and treasury services; and wealth management and financial services, which manages superannuation funds and insurance products for high-net-worth clients. The moat is predominantly regulatory and structural. The concentration of Australia's banking sector means Commonwealth Bank enjoys pricing power on deposits and mortgages, significant switching costs for consumers, and customer stickiness built on decades of brand trust. However, the thesis rests on whether these traditional advantages can sustain profitability in a higher interest rate, more competitive digital environment. The StokTok score is 24 out of 100, which signals caution across multiple dimensions. We score valuation at 0 out of 20, financial health at 6 out of 20, profitability at 10 out of 20, growth at 8 out of 20, and smart money engagement at 0 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Commonwealth Bank is trading at a price-to-earnings multiple of 31.48 times trailing 12 months earnings. For context, that is elevated for a mature financial institution in a developed market, and it reflects expectations of either strong earnings growth or lower risk that we do not believe the fundamentals support. The PEG ratio, which divides the price-to-earnings multiple by expected earnings growth to show whether you are paying for actual growth, sits at 15.42. That is an extremely stretched valuation. A PEG above 2 or 3 suggests you are paying well ahead of the business's organic expansion rate. The forward price-to-earnings multiple is 26.2, which does imply some moderation, but only modestly. The enterprise value-to-EBITDA ratio is not calculable from the data provided, which signals limited disclosure or unusual capital structure accounting. The price-to-sales ratio is 10.32 times, meaning investors are paying $10.30 in market value for every dollar of revenue. Again, on the elevated side for a low-growth financial services provider. Our DCF analysis shows the stock trading at a 0% margin of safety relative to intrinsic value. In plain terms, there is no cushion between the current price and what we estimate the business is fundamentally worth. Wall Street consensus, based on one analyst estimate, provides a mean price target of $90, implying downside of approximately 30% from current levels. Taking both our DCF signal and the analyst target together, a reasonable fair value range in our view sits between $85 and $95. That represents meaningful downside from $128. Market sentiment around Commonwealth Bank leans bullish, driven by broader Australian equity strength and positive earnings momentum. But this sentiment has not yet translated into smart money accumulation at these valuations. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that flags red lights in accounting quality and financial condition, is 5 out of 9. That is a below-average result. A score of 5 suggests the balance sheet is showing signs of stress across profitability metrics, asset quality, and working capital efficiency. The Altman Z score, which estimates bankruptcy risk on a scale where above 3 indicates low risk and below 1.8 indicates distress, is 0.00. That is a distress signal. The company is registering as financially fragile according to the model. This is unusual for a systemically important bank, which suggests either the model inputs are atypical for financial institutions or the underlying credit metrics warrant genuine caution. Cash to debt is 0.43, meaning the bank holds only 43 cents in cash and equivalents for every dollar of debt outstanding. For a bank, this is not inherently alarming because deposits function as a form of liability-backed cash generation, but it underscores the dependence on deposit flows and market confidence. Interest coverage is not available, which is a data gap. For a lender, this metric is crucial in stress scenarios. Current ratio is 0.00, again reflective of banking sector accounting. The traditional working capital metric does not apply neatly to financial institutions. Debt to equity stands at 2.69, meaning the bank is leveraged at nearly $3 of debt per dollar of equity. This is normal for a bank, but becomes a vulnerability if loan loss provisions spike or deposit flight accelerates. The bottom line: financial strength is weaker than we would expect from Australia's systemically important lender. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 0.00. This metric should be meaningfully positive for a mature bank with a durable moat. When it reads 0, it typically indicates data constraints rather than true economic reality, but it is a red flag that we cannot validate earnings quality. Gross margin is 0%, operating margin is 0%. Again, banking sector accounting does not parse revenues and costs the way a manufacturing or software business does, so these metrics are not directly applicable. Net profit margin, however, is 35.11%. That is the earnings that flow to shareholders as a percentage of total revenue, and it is strong in absolute terms. It indicates the bank is converting revenue into net income at an above-average rate. Free cash flow margin is 46.31%, which is exceptionally high and suggests the bank is generating substantial free cash that can be deployed to shareholders via dividends or buybacks, or retained to shore up the balance sheet. Return on equity, the amount of profit generated per dollar of shareholder capital, is 13.42%. That is reasonable but not exceptional for a large financial institution. Peers in developed markets typically generate 12 to 16% ROE. Return on assets, or ROA, is 0.76%, which is the profit generated per dollar of total assets. For a bank, this is on the lower end, suggesting asset productivity is moderate. The profitability picture is mixed. The company generates substantial free cash and respectable net margins, but return metrics suggest efficiency is not compelling. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 6.5% annualized. That is low. It is slightly above long-term GDP growth in Australia, which suggests the bank is not gaining market share or expanding its addressable market in any meaningful way. Revenue growth over the trailing 5 years is 7.3% annualized, barely higher, which indicates the slowdown is not recent but structural. For a systemically important bank with pricing power and scale, single-digit revenue growth is a significant constraint on return on equity and shareholder value creation. The business is not growing faster than the underlying economy, which means future earnings growth will be almost entirely dependent on margin expansion or operational leverage. Book value growth, which measures the expansion of shareholder equity, is 3.2% over the trailing 3 years. That is anemic. It suggests earnings retention and capital generation are not building tangible shareholder wealth at an attractive pace. Dividend yield is 2.57%. This is below the current Australian government bond yield in many scenarios, which means the stock is offering limited income compensation for the risks of equity ownership. The growth picture is uninspiring. The bank is expanding at a sub-GDP pace with weak book value accretion, offering low dividend yield and no evidence of margin expansion to drive future returns. Now let's talk smart money. What institutional capital is actually doing with this name? 0 of the world's top investment gurus, as tracked by research aggregators like Dataroma, currently hold Commonwealth Bank in their disclosed portfolios. That is a stark signal. These are investors like Warren Buffett, Charlie Munger, and other legendary allocators who have demonstrated multi-decade track records of identifying mispriced securities. The absence of any Guru holding is a yellow flag. Among 13F institutional filers, the large asset managers required to disclose their holdings quarterly, only 0.1% are currently buyers, meaning they are initiating or accumulating positions. That is extremely low. As context, a reading above 50% indicates net institutional buying, while below 50% indicates net selling. At 0.1%, we are seeing institutional indifference at best and institutional avoidance at worst. Insider ownership by Commonwealth Bank management is 0%. Management owning very little of the company they are running creates a misalignment of incentives. Executives benefit from stock options and salary regardless of long-term shareholder value creation. Over the last 3 months, there have been 0 insider buys and 0 insider sells. The complete absence of insider activity is notable. If management believed the stock was undervalued, we would expect at least opportunistic buying by corporate officers. The smart money verdict is unambiguous: 0 Guru engagement, negligible institutional buying, and 0 insider conviction. This lack of smart money participation, combined with the extended valuation, is a significant red flag. And finally, the verdict. Let's bring it all together. Valuation. Commonwealth Bank is trading at a significant premium to our estimated intrinsic value, with a price-to-earnings multiple of 31 times that is stretched for a single-digit growth bank. Financial strength. The balance sheet shows signs of stress, with a Piotroski F-score of 5 out of 9 and an Altman Z score in the distress range, raising questions about asset quality and earnings sustainability. Profitability. Despite strong net margins and free cash flow generation, return metrics are modest and do not justify the premium multiple. Growth. Revenue is expanding at 6 to 7% annualized, barely above GDP, with book value growth stalling at 3%. An insufficient foundation for long-term shareholder value creation. Smart money. 0 involvement from top-tier gurus, negligible institutional buying, and no insider conviction further underscore that sophisticated capital is not engaged with this name at these valuations. In our view, a fair value range for Commonwealth Bank of Australia sits between $85 and $95, representing downside of approximately 25 to 34% from current levels. The combination of stretched valuation, weak financial strength indicators, single-digit growth, and complete absence of smart money participation creates a risk-reward profile we view as unfavorable. Based on what we see, this setup warrants caution rather than conviction. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Commonwealth Bank of Australia. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.